A very pleasant morning to you all, ladies and gentlemen, and welcome to the 112 Monetary Policy Committee Press Briefing. We are always grateful to you, the press, for the partnership and the strategic role you play in helping to inform Ghanaians about the bank's monetary policy decisions. This morning's press briefing follows the meetings of the MPC last week. This morning, the chairman will speak to us on the decisions of the committee. Of course, you, the press, will be given an opportunity to ask questions at the end of his presentation. We are live on Facebook at the Bank of Ghana, on the bank's website, bog.gov.gh, and on YouTube, Bank of Ghana. It's time to listen to the chairman. With a big round of applause, I respectfully invite the chairman of MPC and Governor of Bank of Ghana, Dr. Ernest Addison, to deliver his statement for today. Thank you.
Okay. Thank you very much. So, good morning, ladies and gentlemen of the media, and welcome to the press briefing after the 112th Monetary Policy Committee meetings which took place last week. The committee deliberated on a variety of macroeconomic issues, including the impact of the domestic debt exchange on the economy, recent macroeconomic developments, and risks to the inflation and growth outlook. A summary of the assessment and key considerations that informed the committee's decision on the stance of monetary policy is provided below. The global economic outlook remains uncertain despite declining food and energy prices, reopening of the Chinese economy, and improvements in business and consumer confidence. The latest Purchasing Managers' Indices point to some rebound in economic activity, driven mainly by the services sector. Notwithstanding these positive global developments, factors such as the recent financial sector turbulence in the United States and lingering geopolitical tensions continue to keep uncertainty at heightened levels. In broad terms, downside risks remain and continue to drag rebound in economic activity. These are further being compounded by difficult policy trade-offs and sovereign debt distress in some emerging market and developing economies. Against this backdrop, the IMF has revised its growth projections downwards by 0.1% to 2.8% in 2023, compared with 3.4% in 2022. Global headline inflation continues to ease in several economies, reflecting synchronized monetary policy tightening, declining energy and food prices, and an ease in supply chain bottlenecks. However, underlying inflationary pressures have remained strong due to lingering effects of past shocks, tight labor markets, and strong wage growth. Consequently, central banks have continued to tighten policy rates, albeit at a slower pace, as headline inflation moderates. Weaker growth prospects and anticipation of less hawkish monetary policy stance have resulted in lower government bond yields in advanced economies. Global equity prices, which fell following the recent failure of some banks in the United States, have since recovered. In the outlook, the expectation is for further ease in financing conditions stemming from moderating inflation, slower pace of policy rate hikes by central banks, and relative stability in the banking sector in key jurisdictions. On the domestic front, price development since the last NPC meeting in March 2023 point to continued easing of inflationary pressures, with 2 additional consecutive declines in headline inflation. There has been a further deceleration in headline inflation to 45% in March and then to 41.2% in April 2023. The ease in inflation has largely been supported by monetary policy tightening, relatively stable exchange rates, and declining international crude oil prices, which have allowed ex-pump petroleum prices to be adjusted downwards. From the beginning of the year to April 2023, headline inflation has recorded a decline of 12.9%. Non-food inflation has declined by 14.5%, while food inflation also fell by 11.1%. Underlying inflationary pressures are also easing, as the bank's core measure of inflation declined for the 4th consecutive month. Core inflation, which excludes energy and utility prices, declined to 41.7% in April 2023 from 44.6% in March and 52% in February. Similarly, except for banking sector expectations, which was broadly unchanged, both consumer and business inflation expectations dipped in April 2023. On growth conditions, the latest release by the Ghana Statistical Service shows that the real GDP growth moderated to 3.1% in 2022 compared with 5.1% growth recorded in 2021. Non-oil GDP growth was 3.8%, down from 6.6% over the same comparative period. The decline in growth was driven by a slowdown in the agricultural and service sectors, whereas industry recovered, driven by increased gold production relative to the contraction recorded in 2021. The updated Real Composite Index of Economic Activity contracted by 6.4% in March 2023, compared to a contraction of 7.2% in the previous month, and a growth rate of 4.6% in March 2022. The main indicators that weighed down the index during the period were imports, cement sales, credit to the private sector, and port activity. Domestic VAT collections, industrial consumption of electricity, and tourist arrivals, however, improved during the review period. The bank's latest confidence surveys, conducted in April 2023, showed further improvements in sentiments. Consumer confidence improved on the back of easing inflationary pressures, which led to consumer optimism about prospects of future economic conditions. Similarly, businesses met short-term company targets during the period and expressed positive sentiments about company and industry prospects on the back of improving consumer demand and relative stability in the local currency. The survey findings were broadly aligned with observed trends in Ghana's PMI for April 2023, which signaled improvements in business conditions for the 3rd successive month. In the 4 months of the year, broad money supply recorded strong growth driven by an expansion in net domestic assets of the depository corporation sector, largely on account of net claims on government. Net foreign assets, on the other hand, contracted. Annual growth in broad money supply was 45.6% in April 2023, compared with 19.9% growth in April 2022. The growth in M2 Plus reflected in all the components. Reserve money also grew by 46.5% year-on-year in April 2023, compared with 33.8% annual growth a year earlier. Private sector credit generally slowed in line with the tightening monetary policy stance, banks' portfolio rebalancing after the domestic debt exchange, and moderation in economic activity. Nominal growth in private sector credit eased to 19.8% in April 2023, relative to 26.5% growth recorded in April 2022. In real terms, private sector credit contracted by 15.2% compared with 2.4% growth recorded over the same comparative period. On the money market, interest rates broadly trended upward in April 2023 at the short end of the yield curve, consistent with the tightening policy stance. The 91-day and the 182-day Treasury bill rates increased to 19.67% and 22.29% respectively in April 2023, from 16.22% and 16.72% respectively in April 2022. Similarly, the rate on the 364-day instrument increased to 27.04% in April 2023 from 18.93% in April 2022. The interbank weighted average rate increased to 25.89% in April 2023 from 16.46% in April 2022, underpinned by policy rate hikes during the review period. In tandem, average lending rates of banks rose to 31.66% in April 2023 compared to 21.6% in the same period of 2022. The 2022 audited financial statements of banks reflected the full impact of the domestic debt exchange program and the challenging operating environment that prevailed in 2022. Most banks reported significant losses on the back of the mark-to-market valuation losses on their respective holdings in Government of Ghana bonds following the implementation of the DDEP. Other losses were due to high impairments on loans and rising operating costs. The industry posted before-tax losses of 8 billion Ghana cedis in 2022, compared with a profit of 7.4 billion Ghana cedis recorded in 2021. After-tax loss was 6.6 billion Ghana cedis in 2022 relative to profit after tax of 4.8 billion Ghana cedis in 2021. The main profitability indicators, namely return on assets and return on equity, all turned negative in 2022 because of the industry's loss position. The 2022 audited financial statement of banks also pointed to some impairments in capital levels, although most banks posted capital adequacy ratios above the 10% regulatory minimum at the end of December 2022. This was attributed to the effect of the rollout of the temporary regulatory reliefs extended to banks to cushion them against the impact of the DDEP, as was done at the onset of the COVID pandemic. In the first 4 months of this year, prudential data shows some turnaround in the banking sector's performance following the conclusion of the DDEP and following consensus reached among stakeholders on the treatment of losses arising from same. Banks continue to rebalance their portfolios in response to the impact of the DDEP on their balance sheet, shifting away from medium to long-term investments to short-term investments and increases in new loans. In general, the banks returned to making profits in the first 4 months of 2023, broadly reflecting higher operating income. Loan loss provisions also increased relative to a year ago due to the pickup in credit growth and elevated credit risks. These developments culminated in a 47% increase in profit before tax in April 2023 compared with 26.3% growth recorded during the same period a year ago. Similarly, the industry's net income or profit after tax increased to 2.8 billion Ghana cedis from 1.9 billion, representing a 45.8% increase in April 2023. The industry's return on assets increased to 5.5% from 4.7%, while return on equity rose to 36.3% from 22.3%. Key financial soundness indicators remain strong on the back of the impact of the regulatory reliefs. The industry's capital adequacy ratio adjusted for the reliefs was 14.8% in April 2023, higher than the revised prudential minimum of 10%, but lower than the 21.3% recorded in April 2022. The decline in the ratio highlights the increase in risk-weighted assets of banks from the impact of exchange rate changes and some losses on mark-to-market investments. The industry's non-performing loan ratio deteriorated to 18% in April 2023 from 14.3% in April 2022, reflecting higher loan impairments and elevated credit risks. The industry's liquidity indicators have also improved following the implementation of the revised cash reserve requirements. Provisional data on budget execution for the first quarter of 2023 indicated an overall cash budget deficit of 6.7 billion Ghana cedis against a program deficit of 18.5 billion Ghana cedis. The outturn was based on total revenue and grants of 26 billion Ghana cedis, which was below the program target of 33.6 billion Ghana cedis. Total expenditure amounted to 32.7 billion Ghana cedis, below the target of 52.1 billion Ghana cedis. The resulting cash deficit was financed mainly from domestic sources. The corresponding primary balance on cash basis for the period was a deficit of 596 million Ghana cedis against the target deficit of 4.6 billion Ghana cedis. On the international commodities market, prices of Ghana's key exports remain volatile. Brent crude oil prices fell by 21.8% on a year-on-year basis to $82.7 per barrel in April 2023, compared with $105.8 per barrel in April 2022, mainly on the back of reduced demand amid fears of a recession. Cocoa prices remained elevated during the first 4 months of 2023, driven mainly by lower production volumes from top grower Ivory Coast. At $2,612.8 per ton in January 2023, cocoa prices rose by 13% on a year-on-year basis to $2,924.37 per ton in April. Gold prices have remained bullish this year, supported by economic uncertainty. In April 2023, the average price of gold reached an all-time high of $2,000.69 per fine ounce, up by 3.4% on a year-on-year basis. The price volatility and varied production volumes of the key commodities impacted export performance during the period. From January to April, total export earnings declined by 3.6% year-on-year to $5.6 billion on the back of lower crude oil exports and to a lesser extent non-traditional exports, as gold and export and cocoa exports increased. Crude oil exports fell by 36.7% to 1.2 billion US dollars, mainly on account of both lower price and production volume effects, as the 10 fields declined from a production of 30,000 barrels per day to 24,000 barrels per day. However, gold exports increased by 15.9% to 2.2 billion US dollars, driven by higher export volumes. And cocoa beans export also rose by 30.3% to 950.8 million US dollars, largely on the back of increased production volumes. The total import bill over the review period was provisionally estimated at 4 billion US dollars, down by 13.9% year on year, and driven largely by non-oil imports, and to a lesser extent by oil and gas imports. Non-oil imports compressed by 16.8% year on year to 2.8 billion US dollars, in line with slowdown in economic activities, currency depreciation, and easing global inflation. Oil and gas imports dropped by 6.3% to 1.2 billion US dollars due to declining crude oil prices on the international market. The higher import compression relative to the marginal decline in export earnings resulted in a trade surplus of 1.6 billion US dollars in the first 4 months of 2023 compared to a trade surplus of 1.2 billion US dollars in the same period of 2022. The current account recorded a surplus of 661 million US dollars in the first quarter of 2023, compared with a deficit of 554 million US dollars over the same period in 2022, on account of the larger trade surplus, lower services and income payments due to the external debt service suspension, and higher remittance flows. The capital and financial accounts, however, recorded a net outflow of 956 million US dollars compared with a net outflow of 451 million US dollars in the corresponding period of 2022. This was on the back of lower foreign direct investment inflows, portfolio reversals, and other investment outflows. The developments in the current and capital and financial accounts resulted in an overall balance of payments deficit of 354 million US dollars in the first quarter of 2023, compared with a 934 million US dollars deficit recorded in the same period in 2022. Gross international reserves at the end of March 2023 stood at 5.1 billion US dollars, equivalent to 2.4 months of import cover, compared with the end December stock position of 6.2 billion, equivalent to 2.7 months of import cover. Gross international reserves, excluding oil funds, encumbered and pledged assets, stood at 1.4 billion. Net international reserves as of March 2023 stood at 2.1 billion US dollars. With the approval of the IMF's supported program and receipt of the first tranche of the disbursement, gross international reserves have increased to 5.7 billion as at Friday, 19th May 2023, equivalent to 2.6 months of import cover. The local currency recorded some gains amid positive sentiments on developments in the economy. The Ghana cedi depreciated by 1.9% in March 2023 and appreciated by 0.6% in April. The marginal recovery was supported by the successful conclusion of the DDEP, progress made with Ghana's external debt restructuring towards the attainment of the IMF program, weakening US dollar, and muted demand pressures. In sum, the committee observed that the recent global outlook remains uncertain, with concerns about the potential spillovers from recent bank failures in the US amid a credit crunch and persisting geopolitical tensions. Based on these downside risks, global growth is projected to remain subdued in 2023 relative to 2022. Global headline inflation has moderated in many economies, but underlying inflation pressures remain strong due to tight labor markets and strong wage growth. The central banks have continued to tighten policy rates, though at a slower pace, and financing conditions remain somewhat tight. In the near term, expectations for slower policy rate hikes in the US have weakened the US dollar somewhat, supporting investor risk appetite for emerging market and developing economies assets. The committee acknowledged that the developments in the global economy will have implications for the domestic economy. Domestic economic activity remained weak in the first quarter of 2023. The latest GDP data suggested some slowdown, despite the positive signals of renewed consumer and business confidence in the economy. Indications are that growth will remain below potential in the medium term. Performance of the banking sector broadly reflected the general macroeconomic operating environment, as well as the impact of the DDEP, as indicated in the 2022 audited financial statements. However, prudential returns for the first 4 months of 2023 have shown signs of recovery in the profitability of banks and a gradual improvement in solvency positions supported by regulatory reliefs issued to safeguard the stability of the financial sector. The committee assessed that the recent approval of the 3 billion ECF arrangement has reinforced recovery efforts at restoring macroeconomic stability and debt sustainability. This should further help re-establish investor confidence in the domestic economy. While this development is positive for the domestic economy, it is conditional on the strong implementation of the fiscal and structural policies under the program going forward. These include structural reforms on tax policy, revenue administration, and public financial management to boost revenues and reposition fiscal policy implementation on a consolidated and sustainable path. The committee further noted the significant decline in headline inflation from the beginning of the year of more than 12%. The percentage of items in the CPI basket with inflation of more than 50% and above is receding, an indication of a strong return to the disinflation path. This is also supported by core inflation, which is also easing at a fast pace. The tight monetary policy, through additional liquidity management operations to address excess liquidity conditions in the market, relative stability in the local currency, and easing of ex-pump petroleum prices have all supported the disinflation process. Furthermore, the Bank of Ghana has signed the Memorandum of Understanding on zero financing to the budget to eliminate fiscal dominance and allow for a faster ease in inflation towards the target band. These policies should provide the much-needed anchor to reinforce the disinflation process and reset the economy on the path of recovery. Given these considerations, the Monetary Policy Committee decided to maintain the monetary policy rate at 29.5%. Thank you.
Thank you very much. A very big round of applause for Mr. Chairman. Mr. Chairman, with your permission, it's question time. Your name and media house, respectfully, 2 questions, not more than 2. Let's be very brief. Toma, Najeble, and Netele, and George Rafi. So, Toma, please.
Okay. Good morning, Governor. Um, First of all, considering the situation concerning our gross international reserves, which have declined further since the beginning of this year, is any part of the IMF um, funds going to be used for budget support rather than balance of payments support? Normally we know it's used for balance of payments, but the last time we did an ECF, towards the end, they allowed a certain part of use for budget support. Is that going to be the case here, or is it entirely for budget of balance of payments support? The other question is this: has any bank asked for emergency liquidity assistance despite the first quarter recovery? And if any bank does, what will be the Bank of Ghana's stance on meeting such a request? And is any bank going to be asked to increase its capital buffers because maybe the losses of last year have taken money out from the income surplus accounts?
Okay,
Thank you.
Toma.
Good morning, Governor. My name is Najak Bliago with GBC. My first question has to do with the release of the summary of economic reports by the Bank of Ghana over the weekend. What has contributed to the significant drop in the public debt, that is from 575 billion as at the end of November last year to 432 billion as at December 2022? And again, why would the Bank of Ghana not draft a new BOG law entirely rather than revising the old Act 612 for the second time? The first revision was done in 2016, that is Act 918. Considering recent development, both domestically and globally, why won't the Bank of Ghana consider an entirely new act to inculcate the current development? Thank you.
George.
Hello. My name is George for Joy FM. Quick one. When you look at your summary of economic and financial data, and we look at how the city's performance in December impacted heavily on the debt dynamics, does it put some more pressure on BOG to be more heavy in the set of monetary measures in trying to stabilize the city as well as inflation, because of the extra benefit that it brings to the whole economy? And looking at, if I'm right, 141 billion Ghana cedi reduction in our debt stock, if it's really because of what happened in December, that is huge. And if the city should stabilize further, what could be the implications going forward? So should we be more aggressive in this space in trying to do more to try and stabilize the situation going forward? Also, and just a quick follow-up to maybe Thomas' question, but maybe you answer it as well. There are some who are still arguing about the impact of the monetary tightening on the inflation rate slowdown. There are some who also arguing that maybe economic activities have slowed down, there isn't much demand and all the rest, and that is what is fueling the drive. What data do you have at your end to support this drastic reduction in inflation, whether it's attributed mainly to the monetary measures that you've implemented?
Okay, George, thank you. Last one for this one. Hello.
Thank you. Good morning. My name is Elom. I report for Economic Times newspaper. My first question, Mr. Governor, when we look at the IMF program, they were suggesting that we need to tighten our policy rates further, and I just want to know whether this wouldn't be a counterproductive for growth, more especially given the taxes increases and the steep utility prices as part of the IMF conditionalities. My second question is, will the money from the IMF solve our dollar deficit? If not, what next? Thank you.
Okay, hello. Thank you. Mr. Chairman, we are ready for response.
Yeah, thank you very much for these sets of questions. To start with Thomas' question on the IMF resources and whether this is balance of payments or budget support. The IMF was very clear that on this particular occasion, this support is for the budget. So all that means is that we are going to credit the government with a CD equivalent of 600 million CDs, $600 million. So that goes to support the execution of the budget. Obviously, the Bank of Ghana would benefit from the foreign exchange reserve cover that comes with that. So, you know, if it had been a pure balance of payment support, there would have been no counterpart to support the budget. And that would have meant that we would have fully sterilized the impact of the foreign exchange inflow. So this is almost sterilized, liquidity to the budget. And that means that the Bank of Ghana would have to manage the liquidity implications of that budget support. Then your next question was on whether any bank has asked for liquidity assistance. We have not had any bank ask for liquidity assistance, as I said, partly because of the regulatory reliefs that we gave them. Remember, we reduced the reserve requirements as part of this DDEP exchange. But I always make the point that should any bank need liquidity, the Bank of Ghana would stand ready to provide the resources in line with rules for liquidity assistance. And then your other question on whether any bank is going to be asked to increase their capital buffers, the answer is yes. The impact of the exchange has been to reduce the capital buffers of banks. So if you look at the analysis that was done, when we take cognizance of the 3% additional buffer, right, the banks would need to add up to their capital. Right now, we have reduced the capital adequacy ratio to 10%. And we are hoping that over the next 3 years, the banks would be able to rebuild their capital buffers. And hopefully at that time, we may bring in the additional 3% capital buffers. So yes, most banks are working towards that. They have been given a period, I think up to September, to submit to us what their recapitalization plans are. And we will be following up on that to ensure that banks, instead of distributing profits that they have started making, use those resources to rebuild, their capital buffers. Now, Ghibli, I think your question has been answered by Joy FM. Yeah, because he explained to you what led to the drop in largely due to the exchange rate appreciation that we saw. And you all know what happened at the end of last year. The very large depreciation of the CD was corrected somewhat in the latter part of the year, and that helps in terms of the CD value of the debt. I will come to your question on the Bank of Ghana law, but let me, since I've started discussing the CD and the debt, because the question by Joy FM on the CD's performance and debt dynamics, I think it's an important one, and it has to do with the issue of debt sustainability. It's at the very heart of the debt sustainability and the composition of our debt. So when half your total debt stock is denominated in foreign exchange, slight movements in your exchange rate, the sensitivity of your debt to exchange rate movements become paramount in the sustainability of that debt. So this is one of the major problems that we have faced, probably since 2020. Anytime you saw a slight movement in the currency, it complicates, the government has to find more resources to service that debt. And this is how the debt became almost unsustainable over that period. So yes, when you have a high composition of foreign debt in your total debt stock, you must be, sensitive to the management of the exchange rate. But that doesn't mean that the Bank of Ghana's policy is to focus on a particular exchange rate. We are focused on the inflation rate, and the interest rate decisions that we take, are geared towards attaining an inflation target. But the two are interrelated, right? I mean, if you're successful in bringing down the inflation rate, that should also help to stabilize the exchange rate somewhat. And then the impact of the monetary tightening on inflation, I think the evidence is clear. You look at the core inflation numbers, for example. This is the reason why we take out the supply side factors in the headline inflation rate. We take out energy, we take out utility. These are supply side factors. When you strip out all of those supply side factors, you get a sense of underlying inflation, which gives you a better sense of the demand pull impact on inflation. And we see that that seems to be going down as well. So the monetary policy tightening is having an impact. In addition to that, if you look at the expectations of both businesses and consumers in the inflation targeting framework, these expectations are very key, because that is really what leads to price setting behavior by businesses and the people in the market. Their expectations of future inflation, which inform their pricing decisions, and being able to anchor those expectations is key in bringing the rate of inflation down. So now I can go back to Najible's question on the Bank of Ghana's Act. Why don't we bring in a new act instead of revising the old act? I'm not sure if the two of them are mutually exclusive. If you look at the current act, remember they tried to improve it in 2016, but there are still inconsistencies and difficulties with implementation. First, there's the issue of when you talk about 5% limit, is it a stock measurement, right? Because at any time, the central bank has claims on the government from 20 years ago. So is it that we have a stock limit of 5% of previous year's revenue? Or is it a flow starting from a particular period of time? And how are you going to assess, that flow relative to the previous year's revenue of 5%? So there are measurement issues there which need to be clarified. There is the issue of emergency. What do you call an emergency? Let's define it very carefully, and to make it clear the conditions under which the rules can be breached. Then even the procedural issues in the law are not very clear. Who does the reporting to Parliament? Is it the governor or is it the Minister of Finance? All of these issues have to be clarified. In any case, the Bank of Ghana's most of our reporting to Parliament is done through the Ministry of Finance. So the governor doesn't have really direct reporting obligations to the Parliament. For me, it's not very clear So all of those issues have to be properly clarified in the law. And I believe that the need to do those are there. But even if you had the most perfect law, what happened in 2022 would not have been different. Because the choice would have been either to grind the entire economy to a halt, allow government operations to come to a standstill, which is worse than the problem itself. So the issue of the law is fine, but certainly when you're in economic crisis, things have to be done differently. So I think I have Elm and the IMF program asking for tightening monetary policy. I don't think you understood the IMF's issue on this. They were saying you should keep a tight monetary policy stance. Staying put at this meeting still is consistent with keeping a tight monetary policy stance. It's not only when you increase the policy rate that you are having a tight monetary policy stance. And remember, we have several ways of doing it. The amount of liquidity we withdraw from the system matters in terms of the impact on inflation. Where we set the reserve requirements for the banks matters for amount of liquidity in the system. So it's not only the policy rate that does the work. You have several instruments that you can use to do the work, and we decide on which instrument to use at any point in time to achieve the same effect. Will the IMF money solve our dollar deficit? You and I know that it won't, right? I mean, we have a basic problem, which is a medium-term challenge for the balance of payments. We need to do what we have to do to enhance export revenues, and at the same time manage, what we import, do our domestication, reduce our imports of non-essentials, eat local rice. All of those issues are important for long-term balance of payment sustainability. But in the short term, it's important because it helps us meet, our foreign exchange liquidity needs, and helps stabilize the foreign exchange market, helps anchor both our inflation and exchange rate expectations, and brings back confidence to the economy. In the medium to longer term, we need to focus on the real underlying issues of promoting exports and managing imports.
Chairman, thank you. Second round, Natalie, Morris, Maxwell, and then we'll take Mozart. So, Natalie, let's have your questions.
Mine is my name is Natalie from City FM. Mine is a quick follow-up to Nash question on the Bank of Ghana Act. What is the central bank's genuine position on the call to revise it? If it's not because of the IMF calling for it or any other institution calling for it, what is the bank's genuine position on that? And then looking at the summary of macroeconomic data, the import bill saw a significant reduction. What accounted for that? The import bill, the total import saw a significant reduction. What's that?
What accounts for it?
Okay, ma'am.
My name is Morris with GTV. So we've seen a quick banking sector rebound. Did the stress test you did after the DDP point to this rebound? If it didn't, what did you really see? Now, given the rebound that we've seen, do we still need the Financial Stability Fund? And then my second question would be, the government has said it is not in a hurry to go to the capital market. In the very short term, what options do we have to ensure that growth is propelled? Thank you.
Maxwell, and then we'll do Mozart after this.
Funds from it, will it be treated as grants or loans? And the IMF said that the IMF is a bit concerned about the state of the financial sector, and they said it in their report. Do you share in those concerns? Thank you.
Thank you very much. Governor, at the last meeting, you said your inflation forecast for this year is 29%. I want to ask if that outlook has changed. My second question, after the IMF signing, we've seen multilateral lenders coming on board to, I would say, give money to Ghana. I would like to ask how much we expect to receive from the African Development Bank. Thank you.
Okay, thank you. Chairman, we are ready for a response.
So I believe okay, so City FM lately also, the issue is asking the bank's genuine position. That's how you put it. Genuine position on the Bank of Ghana Act. But I thought I was very genuine in my earlier response, that it's important to clarify things in the Act so that we are very clear. Measurement issues, procedural issues, and all of that. I think that that's the position, that we need to improve it, right, to make these things a little clearer. But I also pointed to the fact that given what we went through in 2022, even if those things were clear, right, the central bank would still have had to play that lender of last resort role to keep the economy, on track. Those were the 2 points that I made, and I think they are consistent. Now, your second question was on what accounts for the reduction in imports. This is part of the stabilization of the economy, right? When you tighten monetary policy and you tighten fiscal policy, fiscal consolidation, that has an impact on your import levels also. You reduce demand in the economy. That affects, your ability to import also. So we are seeing that the tightening is beginning to impact the import side of the economy as well, which helps in the correction and reduces the pressure on the exchange rate. And that's exactly what, the framework is supposed to do. So we are seeing the right responses coming in through the import side, and that is helping to stabilize the exchange rate and also helping to bring inflation down. The gentleman from GTV, I watched your Talking Point program yesterday. I think you're becoming a pro. Maybe you should continue with that. So it was a very good program, devoid of all the politics yesterday, last night, yeah. But yes, very interesting questions on the quick, you put it as a quick turnaround in the banking sector. That is a very strong way of putting it. All that we have seen is that they have returned to profitability in the first quarter of this year. But the banks still need to build their buffers, their capital buffers, right? So this is really where the emphasis should be. And I said that even though they have started recording profits, these profits cannot be, whittled away. through distribution to shareholders and all of that, but they have to be conserved so that they would be able to build, their capital buffers. So the stress test that we did, yes, it showed that the banks would need, recapitalization. That's another word for rebuilding of buffers. And the outcome is very much consistent with the stress test that the Bank of Ghana did. And it also means that, yes, we would need the financial stability fund for those banks that struggle to rebuild their capital buffers. This is really the idea behind the setting up of the fund. We expect banks to approach their shareholders first to recapitalize, and some of them may be successful, others may be a little bit more, difficult, and therefore may have to approach for assistance from the stabilization fund. So we still need that stabilization fund. Those banks that are some majority ownership from the state will have to be also capitalized by the government. So the need for the stabilization fund, I think, is clear. Now, your issue about the minister saying that we are not in a hurry to go back to the capital market, that is true. You need to rebuild your credit worthiness. And in any case, you need the rating agencies to reclassify you to a rate that would allow you to borrow. So the framework itself, the 3-year framework itself, shows that growth would slow down before picking up, right? So it's very clear if you look at the numbers in the staff report that has been published. But the process of stabilization itself, when you have an environment of lower price increases, more stable exchange rate, that kind of environment also helps and supports growth, and probably a necessary condition, for investments, to drive growth. So you are right. Right now we are focusing on creating those conditions first, and then when those conditions fall into place, the issue of finding capital investments to push the growth will become critical. You're looking at maybe post 2024, 2025. This is when, the need to find additional capital will be most effective. Maxwell always asks the most difficult questions. I don't know. What is the pricing for the loans on the Financial Stability Fund? It's a difficult one. I think they are still working on it. Well, they are not grants from what I hear, but they are concessional loans, right? So that's where we are. And the pricing hasn't been finalized. It's one of the things why maybe the fund thinks we need to hurry up on that. That's really the main reason why they made those comments. And I think the deadline is to make sure that all of that is done by June, which is next month. Bloomberg. Bank of Ghana's inflation forecast last time we said was 29.5%. So the forecast, I'm not sure, has changed. We are still looking at that. But we're hoping that we will be pleasantly surprised with a probably lower rate by the end of the year. And the reason I say so is that if you look at the inflation profile, I keep stressing that we started at 12.7 or so within 1 year and got to 54, right? So just the base period effects alone should help drive inflation down very quickly, except that you have new shocks coming in. I mean, you know, utility price adjustments have come into play. But assuming that you don't get many of these new shocks coming into play, just the base effects alone should help drive inflation down very quickly. Multilateral lenders, I cannot give you information on that. We don't have it. I know the discussions with the African Development Bank are still ongoing. I don't think they have been very clear on how much they are putting on the table.
Shama, thank you. Last round. Inka, Anaoye, Kingsley, Weston, and Joshua.
Yinkai Bukum from Bloomberg News. Governor, you mentioned, just to piggyback on multilateral lenders, the 1.6 billion from the World Bank came as somewhat of a surprise for some of us. Could you please explain what that funding would be for? It was mentioned in the staff report of the IMF. Could you please explain what that would be for, and if in any way that was a way of appeasing China for the exclusion of multilateral debt? Thank you.
Okay, thank you.
Kingsley, Ghanaian Times. In our previous meetings, you said some of your policy decisions was to mop up excess capital money from the market to drive inflation down. And I'm asking, with the 600 million budget support, is it going to further distort the inflation achievement we have made, or is going to improve it? What's your position on the 600 million injection? Is it going to drive inflation up, or what's your position on that?
Okay, Kingsley, thank you. Nanoye.
Thank you. Good morning. My name is Nanoye. I work with Asasi Radio. Mr. Chairman, the reforms as put out under the IMF deal points to the fiscal, but what input is monetary going to make into those reforms? Also, it looks like the excitement surrounding the Gold for Oil initiative is dying down. When are we expecting the next consignment? Thank you.
Thank you, Weston.
My name is Winston Taki of Metro TV. Thank you, Mr. Governor. In the reports that you just read, you cited that the access to credit to the private sector has declined. I would like to understand some of the key reasons why this is happening, and also you said that the MOU with the MOU between you and the government with regards to zero financing. What structure has been put in place to ensure that that agreement is complied with?
Joshua, thank you. Winston, thank you. Joshua, go ahead.
My name is Joshua Mlanu with the Business and Financial Times. For some clarity, I know for some in the past the BOD limited its FX intervention on the market with regards to certain products which would be allowed, with the government, with the bank would give out some FX interventions for. But in the staff report, it's asking for a further limit to the interventions in order to build the reserve buffers. So I want to know what would be those further limit that which, or should we expect any further limit in that regard? And the second question has to do with the unified flexible exchange rate in the market. If we can get some clarity on that.
Joshua, thank you. Shama, with your permission, last question from Justice. Justice, very brief.
Congratulations on chalking the IMF deal. Now, so if you said banks would need to, increase their reserve buffers, about how much does the bank think will be enough
as the stated capital for the commercial banks, looking at the exchange rate, the depreciation of the CD as of now? Thank you.
Justice, Chairman, we're ready for a response. Thank you.
So the first question, is it Nanoye or some? Yeah. This was on the World Bank DPO loan, right? 1.6 billion over 3 years. But if you look at the DPO policy matrix, the issues vary from fiscal and debt sustainability, financial sector stability, energy sector operational and financial performance, resilience to climate shock. So there are a lot of areas that the World Bank would be looking at. Then the question from the gentleman, I didn't quite get where he was coming from, on the liquidity impact of the budget support. I think this is the question he asked. And as I explained, the difference between balance of payment support and budget support, I sort of went into that if you had a balance of payment support, there is no counterpart inflow to the budget. So it's fully sterilized. That foreign exchange inflow is fully sterilized. But when it is budget support, the CD counterpart goes to support the budget. So you have that amount of CD liquidity so long as the government spends those resources going into the economy. And we have to make an assessment of the consistency, what that does to our liquidity projections. And if part of it has to be, taken out of the economy, that's what we do as part of our liquidity management and open market operations. So it's very consistent with the framework that we have in place. And Nanoye Asasi, the first question on monetary policy. Yes, the IMF reforms mainly fiscal. And what is the monetary policy counterpart? It's an interesting point. So a lot of our problems are fiscal, yes. But there is a, there is a monetary policy part of it, to, ensure that our markets work more effectively, ensure that our inflation targeting is more effective. So there's going to be a lot of work on that. And also to ensure that our foreign exchange market is more efficient. And this is where the question, I'll come back to your question, on the unified exchange rate that they were referring to. So our part of it is, and remember, the central bank is also responsible for the financial sector and also to ensure financial sector stability. And if you go in there, you would see the measures that we are supposed to put into place to ensure financial stability. It's a lot of work to be done. Rebuilding the capital buffers of the banks, making sure that the banks are stable, return them back to the level of robustness that we saw in 2019. We had done a lot of work between 2017 and 2019, recapitalized all the banks, with very strong capital buffers, very strong indicators on profitability, on liquidity, on efficiency. And then we had the COVID-19 come in, weaken those capital buffers. And then now we have had the debt exchange also weaken those capital buffers again. Imagine if we had not done the earlier cleanup, where we would have been today. So we are confident, about the outlook that the banks would rebuild their capital buffers again over the next 3-year period. And then you asked the question about the Gold for Oil initiative. It is still ongoing. We are still buying gold. And I believe that the next shipment probably, I don't know, you can get the details from our financial markets, but the program is still on. And remember, we are not only buying gold for oil, we are also buying gold for reserves, for our international reserves. And this is an area where we have chalked a lot of success. I believe we've almost doubled our holdings of gold within this short period that we started, from the 8 tons to almost 15 tons, except that we also gave some of it up for the oil, right? Otherwise, we would have doubled our gold holdings by now. So it has been a very successful program, to the extent that it also helped, reduce the BDC forward rates, which fed into the pricing of, you know, oil prices at the pump. It has also helped to bring, petroleum prices down, and therefore that policy has been, very, very good, both in terms of building central bank reserves and also helping with the general broad stabilization. So reserve levels would have been much lower without the Gold for Reserves program. And I think it helped us very much during these very difficult times. Winston, Metro, access to credit, private sector decline. Yes, this is to be expected in the crisis environment when inflation is where it was and exchange rates were. The private sector is not able to flourish under those types of conditions. You would also notice that non-performing loans started going up, and therefore the risks associated with lending also went up. So this is the reason why commercial banks would normally not want to lend in that kind of environment. So we expect that as the economy stabilizes, we would see an improvement in the private sector's access to credit. And then you also asked about the structure for compliance on the zero financing limit. This is not the first time we had this rule in place, and we were very effective in ensuring that the zero financing, was stuck to. In fact, throughout 2017, 2018, 2019, we had zero financing. This is the budget, including 2021, right? Including 2021. So the exceptions were the year of the COVID, this is the 2020, and the crisis year of 2022. So we have been very effective in managing that issue, contrary to what you hear out there. Joshua BNFT. Yes, so this is the IMF's issues about the efficiency in the foreign exchange market. And I think they in a sense, when we brought in the controls, right, not to provide foreign exchange for certain commodities, really, those are exchange control measures, and sort of takes away from the liberalization of the foreign exchange market. So in their view, these kinds of, crisis management, they were crisis management measures, that we took, given the environment that we had in 2022. So as the situation normalizes, right, we do not expect to continue, with those kinds of restrictions on who gets access to foreign exchange and who doesn't, because the foreign exchange, resource constraint would probably be reduced. So that's really what they are referring to in that report. And in that sense, the issue of the unified exchange rate, because when you do that, you create different markets for foreign exchange in the country. So if I'm importing rice, I have to look for a different market to go and buy the foreign exchange, probably at another rate to be able to import rice. This is the issue. So we want to, as the situation normalizes, we want to unify all the pockets of demand out there into a single, foreign exchange market for Ghana. This is the theoretical view out there. I believe that was the last question. Oh, is there any? Yes, justice wants the number on the capital buffers. These are numbers vary from bank to bank. Not all the banks have the same problem. Some banks need more capital than others. So it varies from bank to bank. Yeah.
Yeah.
Thank you.
Yeah, thank you, Mr. Chairman. Thank you very much. Press, thank you for coming. Respectfully, let's report accurately. Let's not be in a rush to break the news. You have a very good collaboration. If there's any information, any data, we'll also have some of our directors who are here to provide some clarifications in some of the other issues that you have. Mr. Chairman, thank you once again, First and Second Deputy Governors. Thank you, and members of the MPC, thanks for coming. For our viewers who joined us, live broadcast, and for some media houses, Financial Times, and others who joined our live broadcast, thank you for joining in. God willing, we'll meet soon. Good morning.